Hey everyone, it's Ankit. Welcome to a brand new video. Today we're going to talk about Amazon stock versus Google stock because both of them are going to have a stock split that's coming up very soon, within a month or two. If you're excited about today's video, then drop a like. It really does help out and support everything I'm doing. Leave a comment with what stock you would be buying if both these had a stock split and why. Or if you know of any other companies that might be having a stock split soon, let me know in the comments below. Subscribe if you're new for weekly videos on investing and about health. Let's try to hit 6,000 subscribers. With all that out of the way, let's get into today's video and find out which stock is better compared to Amazon or Google. And I'll let you know which one I'm buying and why. Amazon and Google are two of the world's most recognized brands and Wall Street's most coveted stocks. In the long term, blue chip stocks is still decidedly up. Plus, it estimates that roughly 40% of all web traffic is hosted by the two companies combined. But which looks like the better way buy today, is it going to be Google or is it going to be Amazon? Both stocks have share prices that are well in triple digits. Amazon is about 2,900 and Google is about 2,600. And this was right before Amazon announced that they're going to do a stock split too. Right now, Google is having a better year, up 24% in the last 12 months versus a 5% decline for Amazon. However, over the last 5 years, Amazon has Google easily beaten with 246% total returns versus a 209 total return. Those are some really impressive returns, especially when you're comparing to the 78% return in the S&P 500 in the last 5 years. They're kind of the returns that would make any growth investor happy. Let's take a look at some key numbers for Google and Amazon. So the first thing we want to look at is the PE ratio. For Google, it's 23.99. That's the price to earnings ratio for Google right now, as of March 17th. Amazon's PE ratio is 48.52. Google's PEG is 1.23. Amazon's PEG is 2.35. Google's PS ratio is 7.73. Amazon's PS ratio is 3.41. Google's PB ratio is 7.23. Amazon's PB ratio is 11.58. Now let's look at the profit margin. Google is 30%, while Amazon is 10.42%. Google has the more potential upside. You can't go wrong with either of these growth stocks. If you bought both of them 5 or 10 or even 15 years ago, you would have made a lot of money. But Amazon has been the better stock in recent years, but I think Google is going to catch up and do a lot of amazing things. I think that might change in years to come. Between its cash stockpile and untapped potential revenue streams and cheaper valuation, I like Google stock to outperform Amazon in the next 5 years. In fact, that shift has already seemed to be taking place, with Google plus 61% massive outperforming Amazon plus 5.5% in the last year. It could be the start of a long-term role reversal between two of the biggest and baddest tech stocks on the block. If you would have invested $1,000 in Amazon 10 years ago, the investment would have been now worth $15,000 today. It's hard to say if the next 10 years will be similar in gains, but investors who hold the stock long enough can realize similar returns. E-commerce is still an enormous opportunity for Amazon, and annual online retail sales globally are expected to exceed 7 trillion by 2025, up from 5 trillion today. So some of you might be wondering what a stock split is. A stock split happens when a company increases the number of its shares to boost the stock liquidity. A stock split is a corporate action in which companies increase the number of its outstanding shares by issuing more shares to current shareholders. So let's say you had Google at $3,000 and they're doing a 20-to-1 stock split. So that would mean you get 20 shares, each for $150. And it looks more attractive so other people can buy it at $150. In a stock split, the number of outstanding shares increases and the price per share decreases proportionally, while the market capitalization and the value of the company do not change. So you're still getting the same company and the value is not changing. It's just you have more shares and it'll make it available for other people to buy. So reasons for stock splits. First, a company often decides on a stock split when the stock price is quite high and making it expensive for investors to acquire shares. That's one of the reasons. Second is the higher number of shares outstanding can result in greater liquidity for stocks, which facilitate trading. So what should you do, or what to do? For example, in a typical 2-to-1 stock split, if you owned 100 shares that were trading at $50 just before the split, you would own 200 shares at $25. Your brokerage would handle this automatically, so there's no need for you to do anything or make any changes. So here's what some analysts are predicting for the price targets right here to the right. Here's what they're saying. If it's outperforming, buy, positive, and who's saying all this, and what date this was stated. And this is for Google stock. So don't get me wrong, Amazon is a great stock, and they have a great balance sheet as well. And they're also going through a stock split. So if it falls to the right price, I might buy a couple shares of Amazon as well. They have been missing their earnings when you're talking about revenue.